to joining this webinar today, so hopefully you've all been looking forward to it as well. So a brief introduction to myself before I hand over to my fellow panelists to introduce themselves too. So my name is Faye Mullen and I'm an investment consultant at a firm called ISEO. So I've been at ISEO for, well, formerly KPMG, for just over 10 years, and I started there as a graduate. So the work that I do is giving investment advice to, or largely to, pension schemes. So if you have any grandparents or anyone you know who is receiving their pension, I'm in charge, or I'm part of a team who helps give advice to make sure that your grandparents or others can receive their pension. So we invest their strategy with the objective of making sure that people have enough money to receive their pension. So we'll talk a little bit about what that strategy or the investment strategy might look like a little bit later on. But I'll next hand over to Natasha, who'll just give a quick introduction to herself.
Hello, everyone. Thank you so much for joining us tonight. My name is Natasha Briginski Mounier. I have recently retired from Capital Group, where I was an investment manager for almost 20 years, and I have a total of 25 years in the investment profession as an active investor. And I will just take a brief moment to explain what that means. As many of you know, public markets are essentially comprised of stock exchanges where companies are listed. And then you also have bonds that are traded actively and traded day to day. So that's what we call public market investing. And in that area, you have essentially two kinds of investment approaches, active and passive. An active investing, you're essentially doing bottom-up analysis of stocks and bonds and putting together a portfolio that reflects the fund objectives. And on passive investment strategies, it's a more top-down approach where you are following certain kinds of indices to mimic their performance. So when you think about active investing, think of alpha. Alpha means you're beating the market. And that's what active managers strive to do. We can talk more about my day-to-day and share experiences in terms of what you should expect from a career investment. But I just wanted to lay out this basic overview of how it works on the investment side in active equities.
Thank you, Natasha. Kendall, do you mind giving us an introduction to yourself, please?
Yes. Hi, everybody. I wish I could see you and I can't, but I'm sure you're all lovely. I'm a founding partner of a private equity fund called Patron Capital Partners. We set up back in 1999, and we are what you call a closed-end private equity fund. So it means that investors come in and they stay in the fund. So it's private versus what Natasha was talking about, which is more the public market. We are investing in real estate and anything that has a sniff of a real estate component to it. So it can go from the straightforward buying residential or buying office, and then we can go pubs and healthcare and mortgage lending businesses and distressed debt and secured on real estate. So it can go quite far reaching as a private equity stroke pure real estate or private equity fund. And we have about $4.5 billion under management. And the other thing I do also in my spare time is we set up a social impact fund, which is called Women in Safe Homes, where we try to house vulnerable women who are suffering from domestic abuse or coming out of prison. And that's also a very interesting model, very different to what my day job has been for over 27 years. So that's my world in a nutshell.
Thank you, Kendall. Federica, do you mind giving yourself an introduction, please?
Sure. Good evening, everyone, and thank you for being here tonight. First of all, I must say I'm impressed that 85% of you is already considering a career in investment management. We hope to help you making up your minds tonight. I was in your shoes just probably 10 years ago, and I thought I had it figured out, thinking, okay, I really want to go into investment management, but I had narrowed it down amongst the multitude of jobs in the financial world. But then even within investment management, there are so many careers possible. So there's a lot to consider. And my first advice now would be to keep an open mind, listen to us tonight and more in general. try to explore as much as you can. From my side, I joined JP Morgan 10 years ago, working similar to Natasha as an active manager, rather than on the public equity side, on the public bond side. So effectively selecting corporate bonds to put together a diversified portfolio of securities for large institutional investors like the pension plans, Faye mentioned at the beginning. And just over 2 years ago, I moved from this role of security selection to a more fund selection role. So I am now an investment consultant, helping large pension plans and large insurance companies, university endowments across Europe and Middle East to select funds, investment funds for their portfolios. And I specifically focus on private markets, so no more listed assets, but rather private, unlisted funds in the credit space, predominantly in the credit space, but also to an extent in private equity and real estate.
Okay, thank you, Federica. So I think in terms of a very broad format for the rest of this session, we'll do a little bit of talking about investment strategy, and then we'll think a bit more about kind of day-to-day, the jobs that we do, and a bit more about careers or any advice we have. So I think that was a really nice starter of that, Federica, so thank you for that. So in terms of the spectrum of investment, we have, which Natasha's already started to talk about, public investment, and then the more private side, which is more akin to what Kendall and Federica was talking about. So maybe if we can start with you, Natasha, if you can just give a little bit more insight into public equity, public markets, the type of investors who are looking at those markets. And then we'll maybe hand over to Kendall and then Federica just to have a little bit of a look at the private market investors and what that space looks like in contrast.
Thank you so much. Well, one thing you should remember when you're thinking about public markets is that they're very, very large and they're geographically very diverse. So when we're talking about global equity markets, what we mean by that is actually a composition that reflects about 50% US and 50% non-US stocks. And that includes Europe, Asia, and other countries. So the US is really very large, not just because of the size of its economy, but because so many companies list on US exchanges. And even though these companies may be domiciled somewhere else, the US as a market attracts a lot of companies that list there. So as an analyst covering an industry, you might cover companies in a number of different geographies to reflect that. And when you're thinking about emerging markets, they are huge in terms of geographic spread. They're actually still but a small fraction of international equities. They're only about 15% of the total market capitalization of stocks. And about 3/4 of emerging market companies are domiciled in Asia. So China has become really the most important component of emerging market listed equities. Within the investment world, there are different kinds of funds and different kinds of client objectives. And it's really important to remember that we are service providers. We are intermediaries for other people's money. So it's a very important responsibility. We call it the fiduciary responsibility. We have the role of stewardship and a very important role of being stewards to other people's money that in the long term is going to provide their pensions and is going to provide maybe their kids' educations and houses that they'll buy. So we must think about the long-term implications of everything we do. Some fund objectives meet people's desires for capital appreciation, which means growth over a long period of time. Some funds meet people's needs for dividend income. And so they invest in companies that are more mature and have distribution of their earnings as dividends on a regular basis. So when you're thinking about working in a specific fund, you must ask the question of what is the fund there to do? What is the problem the fund is trying to solve? Some funds do that on a thematic approach. For example, some funds increasingly focus on ESG and sustainable outcomes or impact investments. Those are themes within the broader world of equity investing, which essentially tries to either replicate market returns through passive funds or exceed them through active investing, which is going to be slightly more risky, of course, but meets a different client objective.
Thanks, Natasha. Do you mind? I'll just add a couple of bits to that. So I think you mentioned ESG. So that's just for everyone's benefit. That's environmental, social and governance factors, which I'm sure you'll hear us talk a lot about today because ESG is incredibly topical in the investment world. When it comes to your passive equity strategies or what you've seen, Natasha, what would you say is on the upper end of the most risky sort of strategies you see in kind of the public equity space and the more kind of the lower end of the risk spectrum?
It's a great question. You know, when I talk about risk, what I mean is risk of volatility and risk of losing your money. Those are two separate but linked types of risks. So when you invest in a portfolio of securities, you're always trying to, first of all, meet the client objective in that fund, but in a way that's going to minimize the risk of them losing money or losing sleep. And that is why a very broad portfolio is going to be somewhat more safe than a very narrow one, because you have less likely to be at risk of correlations, you know, when securities in the portfolio end up having the exact same returns in the exact same market cycle and hence not giving you any protection on the downside. And then you also have more differentiated outcomes over time. So essentially, large public market companies tend to be more stable than smaller new companies that have lower liquidity and less of a track record as well. And that's how you should think about sort of the risk over time. And in a portfolio, you would want to have a mix of lots of types of good companies to smooth out returns over time. You know, in general, market cycles tend to be about 7 years, and an average annual returns in public markets are about 7% a year. So when you think about it, you could double your money over 7 years by being invested in public equities in a normal cycle, except that nothing's normal anymore. You know, we've had now a market cycle that's been over a decade long. Market returns in some countries have been extremely strong. Overall global equity returns have been really strong, but it's still really important to keep your eye on that idea that, you know, there is such thing as market cycles and things that go up can also come down. So you must diversify your risk over time.
Yeah, no, that's really useful. Thank you very much for that. So on the subject of risk, I might pass over to you, Kendall. So hopefully you won't disagree with this, but I think the area that you work in tends to be on the slightly more risky end of things in private equity. But maybe if you could talk a little bit around that, that'd be really interesting.
Yeah, thanks, Natasha. That was very, very clear and concise. Yeah, I do lose a lot of sleep actually because I'm in the risk business. So you touched on so many things, Natasha. You need to be careful not to go off in all directions because there's obviously a counter to everything you say in my world. So it's very interesting. So unfortunately, as I can't get feedback, I don't know if I'm going to go too basic, but who are our investors? So our investors usually come and they put their money in various buckets. They're not going to put all their money into my fund because patron capital, because that would be too risky. So we look to make between 60 and 20% returns gross. So that's quite high, but you don't make that sort of money without taking risk. And we are investing in illiquid assets also because we're into real estate generally. So our hold is of a certain period, and so our investors come to us and they say, look, we're a big pension fund, we're Harvard University or whatever it is, and we'd like to, or endowment fund, and we'd like to put X% into high risk. So they will put some of it into patron, for example, and what they'll expect us to do is, as Natasha said, is to obviously manage their money, which means that the world after the global financial crisis is now extremely regulated. So that's also something to think of when you are coming into the investment business. Natasha and I have been around for, having done this for a while, it has changed immensely. It was, I have to say, a bit more fun before because it has become so regulated, and unfortunately a lot of what we do is heavily regulated. And especially in the real estate business, because it's not, global financial crisis was not really sort of to do with us and directly, but we've ended up being hit by the regulation, which doesn't really work for us because we're in illiquid assets. That's another story. But anyway, so highly regulated now, not as regulated as I think in Natasha's business, possibly still highly regulated. Investors come to us, give us their money, we invest in it. We try, what do? We go and underwrite, and I'm not talking about the social impact fund, purely in patron. We will look for, we're an opportunistic fund. That's what makes it's not pure real estate. It's not the real estate that makes it rich. It's the fact that we're an opportunistic fund. So we go looking for problems, things that have their value has not come out. So they're investments or that that either need love and care, and the value has been hidden, and we are super bright and super clever, and we have great local partners, and we're going to go find investments where we think they're undervalued or they're distressed. There's going to be a few of those on the market now, are distressed, and we will come. We're not a vulture fund. We will come and work on them, take out the value, find the value, release, refurbish, redevelop, find better partners, restructure, whatever it is, and then hopefully after 3, 4, 5 years, be able to make a 16-20% internal rate of return on that, and probably a 1.6 cash multiple. That's the objective. As Natasha also rightly says, and both of us having been around for a while, is we have seen many cycles. So we have done 6 funds at Patron. 2 of them got badly hit by the global financial crisis. So it's not, the big question we can talk about separately is, why do you want to go into this industry? And a lot of people think it's easy, you're going to go out and you're going to come out really rich. It's not always that simple, and it's a tough area to work in. But very exciting. So closed-end fund, opportunistic. Our investors come in. We try to give them a good return. We go out. We have local partners and people within the office that go find these deals throughout Europe, and we invest. And we play on the cycles throughout Europe. So what's unfortunately now with COVID, the cycles are pretty much similar everywhere. But before, France might have been behind Spain, or Spain was ahead, or Portugal. You look at a new market, so you're constantly playing around with those cycles, and rarely doing anything extraordinarily clever other than following those cycles around and hopefully getting in at the right time. Where people got hurt, obviously, in the global financial crisis, is they went in overpriced, and then they got badly hurt because they bought things too expensively before, just at the wrong time. How do we get paid, which is also an interesting element, again, in the private equity, is the concept of, we obviously get management fees. But I think, and I don't know a lot about the public markets at all, but this goes back to the loss of sleep, is the private equity world is very much into alignment of interest. So we put our money in to our funds, and because investors like to see the fact that we believe in what we're doing. So it's not purely a fee business. So it makes it exciting. It also makes it, a very dynamic area, I think. But your money is there in it with the investors. They want to see you there by their side. And when they lose, we lose. And so that also is an interesting element of my world. The social impact, and then the exit is, so our fund, just to give you an idea, 3, 4, 5 year hold period, but overall the fund takes 10 years. It's not like quick dirty money and it's all great and you buy and sell really quickly. It's not like that in the real estate world. You see a lot of different things, as I said, healthcare, pubs, petrol stations, mortgage business, whatever. The social impact fund is very, very different. That is also a closed-end private fund, but there you're looking to make 4, 5, 6% return. The objective, the investor who's coming in to our social impact fund is not the same investor, or it might be the same investor with a different bucket coming into our fund. That is looking to have a social impact, as the word actually says, and to make a return based on also achieving, which is extremely difficult to measure, social impact, in this case for vulnerable women. So I don't know if that's enough detail, too much detail, I have no idea. But and as I can't see anybody's reactions, I'm going to assume it's great. So that was my bit. And
can I ask you a few questions on that, Kendall?
Yeah.
So I've been jotting a few things down as you were talking. So you were talking about finding different opportunities. So you go out and you find some opportunities that need you to give them a bit of love. How do you actually find those opportunities, with you and your team?
Yeah, what we do is we have great local partners. So we have, within Patron, we're slightly different than a lot of funds. We have a lot of homegrown to people who started as analysts and grow up, and actually, because they either have a sector specialty or jurisdiction specialty or asset specialty or whatever. So, and then those people, so we'll have a whole German, and we have a whole Spanish team, we have a whole German team, we have a guy who only does special situations, we have a guy who only does mortgage lending business, you know, different areas. So they will have contacts, and then we go into with our local partners, and the local partners will be in Spain or in Italy or in Germany or in England, in their sectors. And the other bit back, which is a very private equity type structure, is we will enter into joint venture with the local partner, and we want them aligned because we're aligned. So everybody's aligned and losing sleep. So we will go in and only do joint venture partners. So it's very much, you know, when you go to a law firm, basically the M&A lawyer is helping you. It's really sort of, once you've got your fund, you're going down doing, you know, you're buying deals with a joint venture, and it's very, very sort of, for me, it's a lot more tangible. Than it's very tangible. You're buying pieces, you're buying buildings,
yeah,
and you're doing it with yeah.
Sorry. One other question that come in, which is just super relevant to what you're talking about. So a question that's come in is how difficult is it to make conversions? So you're talking about real estate. If you go in, you identify an opportunity, you know, how easy is it to change it into something else and make that business profitable?
It depends what you've underwritten, but let's say the distressed loans, which, you know, there was a time, which is how I met the managing director of Patron, as we were working on the first distressed loan deal in France, which was Barclays selling a whole bunch of distressed loans. So they had all these loans which were on real estate, which were secured on real estate. You don't think of a real estate fund buying thousands of distressed loans. We want to buy them, and then you have a good operating manager who's going to go there and literally, so you'll buy a loan for £100 that is owed £100, and you'll buy it for £2, okay? Because the bank is like, get this off my books. I don't need it. I don't want it. Get rid of it. I can't be bothered to try to phone every person. And then you'll have a great operating manager who will go and phone Mr. and Mrs. Smith and say, you know, you got a loan for 100. You know, we bought it for 2, but why don't you just pay us 10? Whatever it is, yeah, because that's a distressed loan business. Other bits might be, you know, the hotel business has been badly managed, and you change management, or there's tax losses that haven't been converted. You know, there's a lot to do. It really depends on every. But it's always thinking out of the box. It's a very creative business because it's opportunistic. You're constantly thinking. Nothing is just plain vanilla. So it makes it interesting, but it does make sleep element a bit difficult.
Thank you for that. We've touched upon sleep and your lack of sleep twice already.
I'm obviously a bit obsessed with that at the moment. Sorry.
No, thank you for that. That was really, really interesting. So, Federica, if I may turn to you. So we've spoken about equity quite a lot already. We've touched upon real estate. I know that you've spent a lot of time looking at credit. Do you mind just explaining the difference between equity and credit, and then just talking a little bit around your experience and the investment strategies you set within credit?
Yeah, sure, absolutely. Well, I think one easy way to start is that in finance, typically higher returns come with higher risk. And that's something, sorry, Natasha pointed out at the beginning, right? Risk can be defined as volatility of your return stream, or just really your downside risk of something going massively wrong, so to speak. So the strategies Natasha and Kendall touched on are more equity strategies, so definitely towards the higher end of what we can call a risk return spectrum. My experience is more focused on the lower end of this spectrum, just because credit is different than equities in the way money is given to a company. So when you make an equity investment, be it private or public, you're effectively buying a piece of the company. You become an owner of the company. When you buy a corporate bond or make a loan to a company, you don't become an owner. You're again just lending this money with the promise that the company will return you the amount in a specified time. It can be 1, 2, 3, 5 years. It can be even longer. But that gives a layer of protection in the sense that if I give the company 100, all being well and the company not defaulting, I'll get back my 100 at a certain point in time. And in the meantime, I'll also collect what are called coupons, so sort of an interim payments, which are meant to compensate me for lending them this money. And this is no different than say a bank giving us a like personal loan for our, I don't know, more basic needs of individuals rather than companies. So just there is this basic difference which makes credit investments inherently less risky, so to speak, versus equity. And already this is a big generalization because there are obviously a lot of nuances, but if you can sort of use a big brush to paint the picture, that's how I would classify it. So as a credit investor, as a credit investment manager specialist, your focus is always going to be on the downside risk. You're not going to profit as an equity owner of the company if the company does stellarly well. So as an equity investor, if you invest in a company who triples, quadruples its value, you're going to benefit on the upside and you're going to make significant gains there. But as a credit investor, you don't care, because all you care about is getting your money back, and your money is what you gave the company in the beginning. So you gave 100, you're going to get back 100, even if the company does incredibly well in its business. So as a credit investor, I think the philosophical difference versus an equity investor is the risk mindset, and this focus on downside protection rather than the upside opportunities. For example, Kendall was talking about, right, turning companies around and make them work again in that perspective. Again, so this is, sorry for Kendall and Natasha if I'm simplifying a little bit, but hopefully this sort of gives the girls an idea. Although I don't know, maybe it's basic and many of them know this already, but I thought of giving a quick picture of this. And then in terms of my experience and, well, actually the structure of credit markets more broadly, there are public credit markets where corporate bonds, so loans to companies, are relatively standardized and traded on exchanges, so to speak, similar to public equities. And investors typically buy these instruments, these corporate bonds, as one of the safest areas of their diversified portfolios. So to provide stable income via the coupons and capital protection. So perhaps in when equity markets might be suffering, you hope that your corporate bond allocation will sort of protect your overall portfolios from significant losses. However, more recently, as a lot of you might know, interest rates have been going down and stayed low for the past decade or so now, making public investments in public corporate bonds a bit less attractive from this yield income generation perspective. So a lot of the investors who are sort of large enough, or those who can take some sort of illiquidity and invest for the longer time, have moved into private credit investment, which basically means that the loans you give to companies are not publicly traded, or you can't buy and sell them as you wish, let's say, but rather you're tied to them and in a sort of closed-ended fund nature, similar to what Kendall was describing. And private credit versus public credit, what private credit offers is what we call the illiquidity premium. So typically when you lock up your money as an investor for a longer period of time, you can get an increased return to compensate for the fact that you don't have access to your money for a longer period of time because it's invested in these loans given to companies. So that's sort of the difference between public and private credit in terms of their returns profile. But when it comes to the actual instrument, it's very, very similar. It's just literally lending money to companies. And then obviously you can lend money to safer or better performing companies, and your return would be lower as a consequence. Sometimes, as Kendall described, you can lend to more distressed companies, trying to help them sort of stay afloat and perhaps turn into a better business down the line. Obviously, in that case, you're taking more risk, and so hopefully your return will also be higher. So there are different components, but that's sort of, if I had to describe credit management in 2 words, it would be risk management. That's really important, the focus on that perspective.
No, thank you very much, Federica. And if I maybe just try to bring this all together, so by an example. So I mentioned at the beginning I was an investment consultant, and lots of our clients actually have a little bit of everything that we've spoken about so far in their portfolio. So Kendall mentioned one of their strategies is looking to deliver 16 to 18% returns. So my clients might have a little bit of that in their portfolio. They might have 5 to 10%, but actually overall, they're trying to put together a portfolio that gives them the best chance of meeting their investment objective. So that if their investment objective is 10 years out and they want to achieve a certain investment return, a lot of the work that we do is actually putting together a portfolio to say, how much equity do I need? How much credit do I need? What's in my portfolio? And as again, Federica says, how do I manage risk within that to make sure I do have the best chance of achieving that objective? So 2 things that we're currently talking quite a lot about to clients. One of them is ESG, so that environmental, social and governance factors. I think that's been hugely topical over the past couple of years, but is only going to get, I think, increasingly on the forefront of people's agendas. But the other thing we're talking about is risk management. So on the back of last year, I think that gave everyone a bit of a shake up to make sure that they did have, or they understood the risks that they are exposed to and how they can manage that within the portfolios. So I'll maybe just ask one question to the panel here before we talk a bit more about our day-to-day job or career and advice, which is, maybe if I turn to you first, Natasha, which is just what conversations are you seeing having with clients this year? So I've mentioned ESG. Is there anything else you think right now, if you're setting an investment strategy in equity, for example, what sort of things might you be thinking about if you're a client? Oh, sorry, I think you're on mute.
Thank you. Sorry, there has to be always one during a call like this. There's a range of things that clients are thinking about, and we as fiduciaries have to think about. ESG is an umbrella term, and it is really a framework for how to think about sustainable outcomes. At its very base, I think of ESG as being a process. It is a process of mitigating negative externalities that arise out of normal course of doing business. So there are environmental impacts that all businesses and households have. There are human capital and social issues that concern everyone who works in the private and public sector. And of course, there are governance decisions that need to be made to ensure transparency and accountability. So for me, the basis of ESG is a bit of a sort of foundation for good compliance and good corporate hygiene. And it's a process. And it's a process that entails your investment managers being involved in the proxy voting, in engagement with companies about regulatory issues, as well as really forward-looking improvement of how they conduct business. Then you can take it one step further and you can say, well, ESG can be a product, because I can focus on only investing in companies that are doing it very well, that already have certain standards of environmental behaviors, certain objectives of environmental targets, certain kinds of human capital policies, and I'm only going to invest in those kinds of companies, and that can be called best in class. Or the opposite, I'm going to invest in companies that are doing it terribly right now, and I'm going to engage with them, and I'm going to make sure that by talking about it forcefully and with persuasion, they're going to improve massively. And so not only will I generate alpha, but I'll also make the world a better place, because they will have a stronger valuation profile based on their improved ESG credentials. There's a third perspective on this, which is impact. You can use ESG to solve specific problems. And so certain funds that target specific outcomes, whether it's really human capital based or environment based, but within again, that umbrella term of ESG, there are certain funds that are trying to solve a specific problem. And I think this is very compelling. The challenge there is not to become a thematic fund. Because if you become just a thematic fund that looks to address, water issues in Africa or education for girls in India, it's all very good in terms of aspiration, but it can be very damaging in terms of returns in a difficult time in the market, because a lot of these stocks are going to be highly correlated. And as we talked about earlier, that high correlation level can increase volatility and reduce your downside protection and potentially cause more damage in the downside. So this is the kind of thing that you constantly have to balance when you're talking about ESG, because it really is a lot of things to different people. And it's even defined differently in specific geographies. The EU is working on very specific classification of what it means to be a sustainable fund. And it's called the taxonomy, which I think is a terrible word. It makes me think of taxidermy for some reason. But it is sort of a classification and a dictionary of terms. And different geographies will have different approaches and regulations as to what green means and how green or not a fund is. So you have to really pay attention to that as well.
Yeah, that's really useful. Thank you very much, Natasha. Kendall, how about you? What's on your agenda at the moment when you're talking to clients who are looking to invest? Is there anything that stands out in terms of topical?
Yeah, I mean, we've just closed our sixth fund, so it's quite topical. And every time I'm amazed at how things change. It's slow, but the investors do ask different questions, and it's quite comforting. A big one for us is obviously track record. So there's a lot more. My ex-husband always phones at this time. Just one second.
I'll give it 10 seconds. No, she's coming back. It's okay.
It happened on the last game call too. So track records are very important for us. We're on our sixth fund, and obviously we spend a lot of time going through track record, how we survived, what we did, and they go into a lot more detail. And so we have about 83% of our existing investors have come back in. So, which is good and bad when you think about it. A lot more questions on ESG.
You said, Kendall.
83%, yeah.
Oh wow, that's a lot.
Yeah, it's huge, and it's used a lot in the marketing. But I mean, we can decide. We can think about whether that's good or. I mean, it's good. I'm not going to say it's bad, but it does mean that possibly we need. You know, if you want to get different type of investors or not, how do you want to grow? So a lot about ESG. I mean, our DD questionnaires now are, I mean, it's a full-time job. I mean, the due diligence questionnaires that come in from our investors are horrific. You know, they're that big, a lot of box ticking, and it's back to my point about regulation and people want to tick boxes. It drives me a bit mad. The reality is we all did it before. We were doing all these good things, and now it's a lot more regulated and you have to tick a box. And sometimes you can't fit into the box. And that's what really drives me mad, is it doesn't give you any scope to actually be individuals. So we're all ticking boxes. So ESG, I mean, our investors now insist that that is a, you know, there's a policy now in place, and it's part of our investment committee process. So back to what Natasha was saying, it's very much a process. And the always things of fear, I always have a fear the process means ticking boxes. But the other great thing is I talked a lot about diversity, which I'd never seen before in this fund. A lot of questions about what our approach were on diversity. And yeah, so it's a lot more sort of nice things to be seeing, the good things that we should be doing to be good people. And good, and back to our fiduciary duty, as Natasha said, you know, investing sensibly. But it does get to a point where, I mean, the sustainability, I haven't even looked at legislation yet, but it has to be in place in next week, I think, by the 10th of March. So yeah, it's constantly something that's coming up. Another acronym that I got to figure out.
No, that's really useful. Well, and I'll come back to the diversity point in a moment as well, because I think that's a, you know, particularly interesting one for the conversation we're having today. But Federica, if I may just turn to you finally, just to talk about, you know, any, again, challenges or questions or key things that you're talking about with your clients.
Yeah, I think Natasha and Kendall really cover it well. So perhaps I'll try to tackle this from a slightly different angle. It's just that E, S, and G, so environmental, social, and governance factors, really might mean different things to different people, to different investors, and to different investment management companies. So the way I try to look at it is go back to basics. So what does investing mean? It means allocating capital. You have a pot of money and you have to either lend it to someone or buy a piece of a company, very basically. And so ESG translates into a mindset. who do I want to allocate my capital to? And that should be your question. Do I want to allocate it to a good company who is, through their businesses, their services, their products, are they contributing to a better world, or what I think is a better world? That's, to me, what ESG really means. Again, taking the E, S, and G and looking whether the company I'm lending money to or giving money to is going to drive E, S, or G in a better place than it is today. Maybe it's too simplistic, but I think it gives a bit of a framework to think about ESG or impact investing as well.
No, that's really helpful. Thank you very much. So if I go back to your diversity point, Kendall, so if you wouldn't mind if I ask you a question on that, and hopefully this will be interesting to those on the call as well, but have you found it being hard being a woman in a male-dominated industry? It's a big question, I know.
It's been so easy. It's just been so easy. Yeah, of course. Absolutely hard. I mean, there aren't any of us. We're very much by ourselves. And even a patron, I mean, we're getting better. And even the way we give our numbers are always a bit, makes me cringe slightly. No, it's been really tough. It's been tough, but not in a, what can I say? I'm of a Jan 55, and I was brought up never to think about gender. So you just survived and you did everything. And my dad brought me up never to think that I was a woman, that I just was doing what I was doing. But I brought my head up above the parapet, about 3 or 4 years ago, and I thought, bloody hell, nothing has changed. And it's been tough. And I think we're partly, every generation of women has done their bit. And but I think we have proved that we can do it. A great article in the FT many years ago, but we've proven that we can be doubly tired and bring up kids and do this and do that and do what men do and whatever and get to the top. But it's the next generation seems a lot less. But we fought, but I think very individually. And I do believe what's extremely important, and there's a lot more understanding and acceptance of it. And I think the next generation of women will not necessarily want to do exactly what we did, but at least we've shown that we can do it. But I'm not sure that they'll want to pay this price that possibly some of us had to pay to get there. So I wouldn't say it was a walk in the park. I'm sure if I'd been in media or some other industry, they would have been an easier, kinder, possibly, I don't know. But it's not a lot of us. And I have one small anecdote. I was at I was sitting on a panel on women in fund finance, and I turned the question to the audience, which was full of bankers and therefore mainly men. And I asked them how many of them had daughters, and a bunch of guys put their hand up. And I said, how many of you want them to go to university? And they all put their hand up. And I said, well, how many of them have you want your daughter to go into finance? One poor guy put his hand up, but he was brave enough to put his hand up. But that was it, which says a lot. So, I mean, we have a responsibility, which is what GAIN is about, to show that it is, it's doable. To say that it's easy, I'm not sure that's, I don't know. I wouldn't say it's easy, but hence why we're hopefully helping.
Yeah, that's really, really good. Thank you very much. Natasha, would you have any advice to anyone who is put off or intimidated by, this industry, given that it is male dominated?
Absolutely. You know what? I'll take the other side of Kendall's excellent narrative, and that it's been an extraordinarily rewarding experience to be breaking the ice and breaking some ceilings and breaking some other things along the way for these last 25 years. So I was born in the Soviet Union. I'm from Ukraine originally. And the one redeeming quality of the Soviet Union, if I may say, is that women worked, just everybody worked. And so I grew up with the understanding that, I'll end up having a career and, it'll be challenging. And, I have goals that I'd like to accomplish. And because we immigrated to America when I was an adolescent, as you can tell from my accent, which never went away, financial independence was a really big objective of mine. And a career in finance is a wonderful way to assure that. And there are few careers that can give you that kind of a constant learning opportunity where essentially you get better with age. So I think you'll agree that Kendall looks spectacular and seems like she's pretty happy and accomplished individual. I would say that it was really, really stimulating and rewarding for me to be able to meet so many extraordinarily smart and ambitious people, travel so much back in the days when we did, and now learn new technology all the time, you know, to avoid travel and make the most of what we've got. I think what's really exceptional about a career in finance and investing in particular is that you're constantly learning and you're constantly improving your skill set. So there is an atmosphere of growth and personal development that I think is unrivaled in many other careers. And it's also very transparent. So I think as a woman, it's really important to have that transparency, because then you can be measured by your merit. You know, you have your results and you're part of a team that has results, and you're part of a fund or part of a process that measures results. So it's not arbitrary. It's not nearly as political as many other careers I can think of, again, in sort of professional services, where if one of your aims is to be financially independent and continue to sort of grow your skill base and your brain and your knowledge of people in different cultures, I think this is a great outcome. Now, one thing that was very important for me is to have a partner that supported my vision. And my husband is French, as you can tell from my really difficult surname. And the unexpected twist in our family life is that he decided to become the lead parent when I became a partner, because he was not as thrilled working on the trading floor, for the years that he had spent doing that at UBS. And so he was sort of less excited about his prospects than I was about mine. And so when our kids were in primary school, we have 2 sons, the hardest thing I had to do is to retrain the school from calling me when they had a fever and to call him Mr. Mounier instead. And that was quite a challenge. I think that's one of the women's greatest challenges, actually, if you're working and you've got kids. Schools and other mothers by default will assume that you're the point person. And if you're not, it's an emotional journey and a logistical journey to assure that they know otherwise. But, I now have 2 very, very happy boys who really value the importance of women in the workplace. And my elder son, who's now a freshman at Georgetown, has worked very hard to make sure that his girlfriends come talk to me when they want to interview for an internship in finance, because he finds that many of them are just not even looking to go there. They're looking for jobs they think they can do tomorrow, not things that they may want to do, but are not sure that they can do. So I urge all of you to think about not the job that you can do tomorrow, but the job you'd like to do 10 years from now, and what could be interesting for you to learn, and not just the things that you're sure you're going to excel at from day one.
No, thank you for that. And just to elaborate on your support point, so for me, actually, some of the support has been through other females in the business. So I'm quite lucky that, I have some incredible role models in the team that I'm in the business that I'm in. But actually, the culture itself is very supportive. So there's not only the female network, where actually, I think females in the team like to see other females succeed, and there's a bit of camaraderie there, even though there's not that many of us. I actually find that really nice. But actually, I do think that there's more guys around who, they're starting to work part-time, or they do have daughters and they actually recognize some of their biases or stereotypes and are trying to challenge themselves a little bit more. I still think we've got far to go with that, but I think it's definitely something that seems to be on people's minds more. But I do think that support mechanism, having role models and things like that, can be really useful as well.
And if I can add to that, I think one of the challenges of having few women in finance is that younger women might not have in mind a role model for them. So sort of like an ideal person to be, like, to aspire to be or to look up to. That makes it more difficult. So when you find that role model, like, treasure it. And to echo Faye's points, I think it's very important also to find mentors and sponsors throughout your career from very early on. So someone you can sort of trust and rely on for advice, for questions. You have to be your first cheerleader, in my view. You have to believe in yourself, and that's something that takes a lot of work. But then you also have to be able to knit a network of trusted people around you. It can be your partner, definitely, but it can also be a colleague or someone who works in the same firm but a different division. I think that starting from yourself, but building a close network of trusted partners around you, it's what I would say is the most important thing to be a woman in finance.
Yeah, just to add to your kind of own cheerleader point, Federica. So I had somebody once who told me, and this was a senior guy in our team, who said, "You've got to stop looking for the role model. You need to just be a role model yourself." Like, you need to, and I think, hopefully other people on this call as well who are listening is have confidence in yourself and what you can do. And actually, you are capable and you can be successful in these sorts of careers if you want to be. And, there's, as you said, there's lots of help that you can get around, but actually just having the confidence to, challenge yourself and just go for it. Like Natasha said, it's not just about the tomorrow, but longer term as well, what you can do.
I think there's one discerning factor that Natasha raised, and I took a slightly different view, but whoever is listening to us are quite young and probably are not thinking yet about having children. Going into the finance industry until you have children. And I don't know how this changes. Unless you're in Natasha's situation where some of us have been, and there is somebody who takes a back seat, does the other role. Which isn't always the case, but that is what differentiates us when it gets into the finance world, because it is I have 4 children, and it's not one that is made for an industry where you're going to be accepting that you're going to pick up. It's different now because of the men, and the more men role models, the more women show that they can do both jobs or that they have somebody else, I think unfortunately is not the way. I think the way it changes is we have men as role models, and that is so many of these women groups. I think I'm seeing that point. Is that if the men are not showing how it gets done and how they're supporting their wives, not if they want to take that role at home, but even as it just becomes the way that we do business, and everybody's working together, whether you're on the buy side, sell side, service provider, not service provider, but there's an understanding that there's a life to be led and there are children to be brought up. I think for me that's if I can achieve that, that would be I'd be very proud of that.
Okay, so I do need to hand over to Vicky shortly, but I think if anyone else has got any closing comments, Kendall, I think you've just ended on a nice note there, but if anyone else, Federica or Natasha, if you have anything to add, otherwise I'll hand over to Vicky. But I personally have really enjoyed the conversation, so hopefully everybody else has as well.
I just want to add one thing. In doing many of these sessions and talking to many of you offline, there's a tendency of trying to find the perfect fit for you as it stands today. And I think there's great value of you actually for zooming out and seeing the entire spectrum, the whole value chain of the finance industry and the investment community, and learning more about it by just reading the FT every day, and try to read The Economist and try to read some of the industry literature to understand a little more the narrative and the vocabulary and the concepts, and then you'll find the right fit. But don't try too hard to find that fit today, because you would be limiting yourself a bit. And it's really a very exciting and big world out there of opportunities. And it's a great time to be a girl and going into the investment industry.
Yeah, sorry, just one last point to build on this. Don't think of finance as a sort of a big monster to be intimidated by, but it's very accessible, and there are many paths to it. And to begin with, as Natasha said, it might be as simple as opening a newspaper. Like nowadays, there are so many ways to stay informed. You can listen to a podcast, read a book, watch TV. Internet is a big source of information, blogs, communities, events like this, effectively. So like there's really no excuse. You're all more than capable to start a career in finance if you wish to. It doesn't mean that you have to. Not everyone needs to do that, but I'm sure you all have the skill and the potential to succeed.
Yeah, and just one final one for me is just be yourself as well. You don't have to fit a certain mold, or you don't have to, it's about, it's nice to have different personalities and different backgrounds, and I'm sure, you'll do well. Okay, Vicky, I think over to you.
Thank you all so much. Thank you to all of you for being here today. And I'm sure you will join me all in saying a massive, massive thank you to our panelists. This is why sort of GAIN exists. Towards the end of the conversation, we're talking about role models. It's to sort of provide women and men that you can look at and know that you can do it because they're doing it and they're telling you how they did it and what they like about what they do. And so yes, I hope you all enjoy that conversation. It was extremely insightful. Thank you to all our speakers for being here today and sharing all that you have, because it's been incredibly interesting and I'm sure it's going to really help our audience. So on that note, we're coming to the end of like our spring program, but we've got lots of stuff coming up in summer. We've got a lot of events still going with sort of partners and partner universities. So do stay in touch with us. You can find us on the GAIN website, which is www.gainuk.org. We're on all the social media channels. So we're Girls Are Investors on Facebook, LinkedIn, and Instagram. Twitter's the odd man out there, or odd woman out. It's just Our Investors, no girls in front of the Twitter handle. And yes, please stay in touch and hopefully come along to another seminar or webinar, and hopefully we'll see all our speakers again soon. Please join me in saying a massive thank you to them all. Thank you so much.
Thank you. That was great. Thank you.
Bye.
Thanks all. Bye.
Bye, everyone.
Have a good evening, everyone.
Thank you.
Thank you, Vicky. Thanks, everyone. Lovely to meet you.
Thank you. Same.